Hey, Bill. Thanks for that great introduction. So with the next hour that we have together, what I accomplished is show you how you can take advantage of all this growth we're seeing in the cash balance space. We saw a 30% increase last year in the number of cash balance plans that went into play in 2014. Hoping I can, at the end of this presentation, empower you with some tools and strategies to help grow your business, cash balance plans, and last but not least, give you a clear understanding of the cash balance marketplace, what's happening today, and maybe go out on a limb and make some predictions for what we think is going to happen in the future with cash balance programs. This right here is one of my favorite pieces, and I would encourage you to reach out to TRA and get a copy of this chart. This really shows the power of cash balance plans. If you look at it closely, we divide it up into ages, and you can see in a 401k profit sharing plan, the most that can go in between 401k deferrals, match, and profit sharing is $53,000 a year, $50,000 if you're over 50. For a lot of companies, for a lot of business owners, that's plenty. TRA has a great 401k profit sharing product that works well for you and your clients. And if that's your client's needs, you should probably just stop there and encourage your client to put in a 401k profit sharing plan, TRA. However, if there's a desire amongst your business owners to save more in a retirement plan, for the owners and executives or the partners, there's a desire for them to reduce their tax liability by more than $50,000 a year, that's where a cash balance plan can add a tremendous amount of value. And these numbers, you can save between 401k profit sharing and cash balance. Your client starts to approach his or her late 60s, we can help them defer up to $300,000 of them into a retirement program, shield that from taxes between 401k profit sharing and cash balance. So this is a great chart. I would encourage you to reach out to TRA, get copies of this chart, and use it as a marketing tool. A lot of people have been told that the most they can save into a retirement program is $18,000, or maybe they've been told they can't even do that because of something called a 401k test, and then they're surprised, very pleasantly surprised, that they can contribute significantly more to a retirement program, and that's where a cash balance plan can add tremendous amount of value. At Kravitz, we've been doing cash balance plans since 1989, and we've been fortunate enough to partner with TRA since 2009. But after 2012, we've never seen more activity in the cash balance space than post-2012. So what happened after 2012? Well, for individuals making more than $250,000, their tax rates went up significantly. Let's take a look. 2012, just a friendly reminder for your clients, or if you make more than $250,000 a year, you're now being hit with a new investment tax, a new pay tax. Your cap gains dividend tax went up to 24%. In fact, there's something that people didn't really realize until they started filing their tax returns in 2014. If you make more than $250,000, those itemized tax deductions that we also enjoy, charitable contributions, mortgage interest, paying property taxes, those start to phase out. And if you or your client are fortunate enough to make more than $450,000 a year, your highest federal marginal tax rate went to 40%. Well, according to most tax advisors, the best way to help your client shield themselves from this onslaught of taxes that we saw post-2012 is a tax deduction that reduces your client's adjusted gross income, also known as an above-the-line tax deduction. And that's the beauty of cash balance plans. That's the beauty of helping your client put away money into a qualified retirement program. It reduces their adjusted gross income, which will shield them from these taxes, much better than a below-the-line tax deduction, such as mortgage interest, charitable contributions, property taxes. Not only do those tax deductions not reduce your AGI, but because they're below-the-line tax deductions, they start to phase out clients earning more than $250,000. So because of that, we've seen a huge increase in the number of cash balance plans as people look to shield themselves from this plethora of new taxes that went into effect in 2012. In fact, I really love this slide. This is a real-life example of one of our clients with TRA, and it shows how we were to help a TRA client save over $50,000 in taxes putting in a cash balance plan. Look at this example. That's only the federal tax savings that we're showing here. This client saved even more money if we took into consideration the state taxes and the payroll taxes. But by helping this 55-year-old business owner, client of TRA, put in a cash balance plan, and he made a contribution of $150,000 to the plan, we saved him just in federal taxes alone $50,000. Here's an example of a TRA client, a 6-year-old doctor, in which we were able to help him put in $200,000 into his cash balance plan, reached his federal tax liability that year by $77,000. Again, we're showing the other benefits of these plans, the state savings, the savings in payroll taxes. Mention the fact, and I'll get into this in a little bit, how we help these two clients accumulate a lot more money for retirement. But just tax savings alone, that benefit alone, is why these plans have become so popular amongst, and I'll go into who they're real popular, but particularly in this group, a medical group and a small business owner. These plans are so appealing to advisors. We've had a lot of advisors that work with TRA approach us about, why they should get into the cash balance business. They're doing well with the 401k plans. Well, I would argue, the beauty of helping your client put in a cash balance plan is suddenly you're working with the executives, the business owners. It gives you access to the boardroom as opposed to a 401k plan, which I would argue, gives you access to the HR professional. And I don't know you, but I would much rather be meeting with the CEO, CFO of the business or the small business owner than working with the HR professional in terms of, helping my cause and demonstrating my value to the client. Also, another reason why these plans are so appealing to advisors is it gives you access to a 401k plan. I'll get into this in a little bit, but oftentimes these cash balance startup plans, they're brand new plans. There might be $500,000 of contributions going in a year, but they're definitely startup programs. An advisor, would look at that as maybe something not so appealing. Well, remember, cash balance plan gives you access to the 401k plan, and there might be a mature 401k plan there with $3, $5, $10 million. And because these plans are tested together, oftentimes the client will look to one advisor to help them with the retirement program, which includes that 401k plan. In terms of taking advantage of the growth, like I said, because of the tax rate increase we saw a tremendous amount of growth in the cash balance marketplace. In fact, just to give you some numbers, we saw over a 30% increase in the number of cash balance plans that went into play last year. Compare that to 401k plans. There was only a 3% increase in the number of 401k plans. No doubt 401k plans are a mature market, while cash balance plans is the fastest growing market in the qualified retirement space. So what do you do as an advisor? Well, here's 5 tips I would recommend if you get started in terms of trying to grow your business using cash balance plans. Number 1, lead with design. Let TRA and Kravitz, put together a plan design, and let us help you show your client how we're going to help them reduce their taxes and increase their retirement savings with a cash balance plan. Investments will follow. A mistake I see some advisors make is they're quick to want to have that investment discussion before we really get into the tax savings and retirement accumulation discussion. So definitely partner with TRA. Let us help you help the client understand all the benefits, the tax savings, the retirement savings in the plan design, and then investments will follow. Tip number 2, develop a champion. A number of clients, I'll give you one example, a medical group, where there was 5 doctors at this group. And what we did with TRA is we found one doctor in that group. That advisor had one doctor as his client, and that doctor became a champion for cash balance plans. And he was able to create a grassroots effort amongst his other partners, get some interest. We had a meeting with that client, and we were able to convince that client to put in a cash balance plan for that medical group. Tip number 3, Kravitz years ago hired a marketing firm to analyze what was driving and what was motivating the cash balance sale for our advisors. And even though, we're in the retirement plan space and we might think it's all about retirement accumulation, that's a long-term benefit. The short-term benefit is what typically motivates these clients. So definitely focus on taxes first and then, demonstrate to the client that they'll have, $2.6 million potential retirement benefits at retirement age if they maximize these plans, but definitely focus on the tax savings. And I know TRA can definitely help you with those calculations. Number 4, cash balance plans are typically invested, the money is typically invested conservatively. And, sometimes we used to hear complaints that, gosh, I'm only going to get a 4% or 5% rate of return. Today, with the stock market being so volatile, I'm not hearing that complaint as much as I used to. But as an advisor, you know better than us that the client does need, a conservative asset allocation as part of their overall investment portfolio. Definitely help the client understand the beauty of this cash balance plan. It can be your safe money. And tip number 5, this is actually one of my favorite tips. Definitely get the accountant involved in the sales process. It's my favorite tip. I've been burned by this myself. I've worked with an advisor before presenting cash balance to a small business owner. After we did what we thought was a great meeting and explaining the benefits of a cash balance plan, typically that business owner, after we leave the room, calls their CPA. We find sometimes if we don't include the CPA in the sales process, one of two things can happen. The CPA could potentially be embarrassed that they didn't bring this innovative tax strategy to their client, and as a result, he or she might tell the client some story of a defined benefit plan they worked on back in the 80s and how it blew up on another client and discouraged the client from putting in the cash balance plan. Or first, the CPA says, this is a great idea. Don't work with TRA and the advisor. Work with my team. I have my own team of cash balance experts that I could bring to the table. So what I would encourage you to do as an advisor is get the CPA involved early. Find out who that accountant is. Get them on your team. Not only will it help you close this particular sale, but it might give you access to another sale that accountant could become a client of yours, as well as other clients of that CPA. So anyway, I hope these 5 tips were helpful. We think these have worked for us in the past, partnering with TRA, so hopefully it'll work for you. One thing that you might, and I already mentioned this earlier, number 4 is, cash balance is your safe money. It's everything. With the stock market being so volatile right now, we're getting a lot less pushback on the fact that cash balance investments are typically conservatively invested. So definitely sell the safe money story as you're going out and telling this story. I'm getting some questions, and what I'll do is after I finish the slide, I will actually, Janine Chung from Kravitz will come back and answer those questions, by the way. Okay. Certain states were also finding cash balance is more popular than other states, and in your geographic location, medical hubs, where there's a congregation of medical groups. The 26% of all cash balance plans are sponsored by medical groups. To be more specific, we're talking about specialty groups. We're talking about radiologists, cardiologists, anesthesiologists. If you just so happen to be fortunate enough to live in an area where there's a proliferation of those specialty groups, we tend to see a lot of interest in cash balance plans, and you can use that to your advantage. Taxes. If you're unfortunate enough to live in a state like California where there's higher state taxes, and let's turn lemon into lemonade. Yes, you're going to pay higher state taxes, but there's a lot more potential cash balance prospects for you. So definitely, California, I used to go around many years ago and tell people for every $1 you put in a cash balance plan, I'm going to save you about 40 cents on taxes. Now accountants here in California tell me, no, Dan, tell most of my clients we're going to save them over 50 cents in taxes for every $1 they put in a cash balance plan. So depending where you are, you might also experience, like we do here in California, some high state taxes, and then use that to your benefit. Population and age, Florida is a great example. I'm going to go into which states we're seeing a lot of growth, where baby boomers are getting older, they're nearing retirement. These business owners are looking for ways to defer more for their retirement we find balance plans are real popular in those sectors. At least when we do our cash balance research and when we peel back the onion to see why and where we're seeing a lot of cash balance growth, you as an advisor actually can impact the numbers that we see. Remember, there's only about 15,000 cash balance plans across the country, and when we see an advisor decide that he or she is going to actively get involved in terms of growing their business using cash balance plans, usually 2 or 3 years later, when we do our cash balance research report and look to see where the growth is, we usually find that you'll have an impact on the overall growth of cash balance plans. So, no doubt, people don't wake up in the morning and want a cash balance plan. Somebody has to go out there, explain to them the benefits, help them understand how much money you're going to help your client reduce their taxes, save for retirement, and suddenly, boom, we see a lot of cash balance growth in that area of the country. Because it is the number one driver, these states in particular, a lot of activity. So if you're fortunate or unfortunate enough to live in California, Hawaii, Oregon, Minnesota, Washington, D.C., New Jersey, New York. It's not a coincidence that we see a lot of cash balance activity in these of the country, and a lot of it has to do with the fact that these areas have the highest state taxes. Okay. So hopefully sales tips were helpful. Hopefully helping you understand what's driving growth was helpful. If you're looking to market your business using cash balance plans and start marketing for prospects in the space, we want to go through choosing the right targets, and I'll talk a little bit about who you should go after. I want to help you understand how to build your network so you can grow your business. You want a message, so I'll talk a little bit about key messages you want to stay on when you're marketing these programs to prospects. You want to partner with experts, and working with TRA and Kravitz, we think you're in great hands already. And definitely use some smart tools. TRA has some great marketing materials that you can take advantage of when you go out and market cash balance plans to your clients. So let's start with number one, choosing the right targets. So first off, remember, this is not a mass market product like a 401k plan. Balance is no doubt a niche product. It's not for everybody. In terms of who is ideal, well, remember 2012, tax rates went up on anyone earning more than $250,000. So typically most regions of the country, when we find business owners or executives earning more than $250,000, we to shelter that money from taxes, to use some of that disposable income to save for retirement. Now, truthfully, in certain parts of the country like California and New York, it's probably a higher number. So, anyone earning more than $250,000 in taxes, maybe you should be visiting with Speaking Cash Balance. In California, it might be anyone earning more than $400,000 a year. So you probably know better than me in your area of the country, where people start to really feel the tax bite and have some disposable income to for retirement. Who is ideal? No doubt baby boomers. Baby boomers are looking to squeeze 20 years savings into 10, and there's no better way to do that than with a cash balance plan. In fact, we have a client with about 1,000 partners, 1,000 doctors, and they got a 90% participation rate in their cash balance plan. And what really drove the growth what really drove participation in that plan was this factoid that the retirement committee used when they went out there and marketed cash balance plans to the 1,000 doctors. You need $1 million at age 65 to generate $50,000 for the rest of your life. And they would ask this rhetorical question to these doctors, are you on a path to have $1 million at age 65? Oh, can you live on $50,000 a year? And most doctors said no. They weren't enough savings with their 401k plan to get to that $1 million number, nor would $1 million be enough. A lot of these doctors need a couple of $1 million at age 65 and have enough money at retirement. So no doubt baby boomers looking to catch up on retirement. It's a great prospect for these plans. Familiar with something called new comparability plans or cross-tested plans? These are 401k profit-sharing plans where your client's already maxing out, getting the full benefit, the full $53,000 or $59,000 benefit between 401k match and profit sharing, that's low-hanging fruit. Those clients are already maxing out their 401k profit sharing plan. You need to meet with them and talk about cash balance plans. I would argue if you're not talking to your client that has a new comparability plan about cash balance, somebody else will. So if not a proactive way to grow your business, at least present cash balance plans to those clients defensively so that you don't hear it from one of your competitors. I would hate for you to lose a 401k profit sharing client to someone who brought them cash balance. So you want to bring this innovative strategy to your new comparability or cross-tested planning clients. Who else is ideal? Professional service firms, medical groups, accounting, law firms, financial services, small businesses. That's where we're seeing the growth. I'll go into the numbers in a little bit, but no doubt when we look at who's cash balance plans, it's primarily profitable professional service groups, primarily small businesses, and then the number one consumer is medical. Peel back the onion on medical, we're talking about specialty groups, orthopedics, radiologists, cardiologists, anesthesiologists. That's who you want to go after. Who to avoid? We want to avoid groups with unpredictable profit patterns. We want to avoid people who are not willing to give their employees anything. Sometimes I'll be doing a cash balance presentation, and we'll show how we can put in a large sum of money for the owners and executives, but yet give the employees typically anywhere from 5 to 8% of pay as a retirement benefit. And I'll get this question, okay, we want to do the program, Dan, but we don't want to give our employees anything. We just want to give contributions to the owners. Well, sometimes we can do that in the cash balance plan, but we must make a profit-sharing contribution to the rank-and-file employees, typically anywhere from 5% of pay to about 7.5%, 8% of pay. We don't necessarily have to give it to all the employees, but we're going to have to give it to some to pass IRS testing. So if a client that's unwilling to go there, it won't work. Sometimes we run into law firms or medical groups or other businesses where the partners don't get along. There's a lot of internal discord. Those can be challenging groups to have a cash balance plan. And last but not least, number 4, challenging demographics. When the owners are a lot younger than the employees, that can be troublesome. 2 great examples here in California that come to mind, or sometimes in the entertainment business. Our business owners are younger than their staff, or up in Northern California in the technology space, we find sometimes those clients, again, the business owners are a lot younger than the staff. Okay, so who to avoid? I already covered this. We want to be careful about people with unpredictable profit, kind of boom and bust cycles, because oftentimes they can only make the contribution for 1 year, and if that's the case, it's difficult. It's difficult. It really doesn't make sense to have a cash balance plan for just 1 year. Often we recommend that you plan to have the plan for at least 3 years at a minimum. Not to say the plan could not live for less than 3 years if there was a business reason for ending it before then, but you definitely, from the setting that up, cost of terminating it, it doesn't look good to have a cash balance plan for 1 year, so you need to be able to explain that if the plan was audited, so we want to avoid these type of clients. Build your network. I would definitely encourage you to review your existing list for targets. Remember, look at comparability plans, cross-tested plans. Your clients are already maxing out their 401k profit sharing and match. Look for those specialty medical groups, small businesses, family businesses. Great low-hanging fruit in terms of who you should approach with the cash balance story. A lot of our advisors that we work with had great success partnering with CPAs. Accountants, can be a great resource. They know the tax struggles of their clients, and they could bring you a lot of business. Sometimes it takes a little work to get CPAs to be proactive and partner with you, so no doubt it takes some work, but if you can get a CPA to work with you and bring this innovative strategy to their clients, they can be a great resource of cash balance prospects. Networking with professional service firms. There's I know of a advisor that actually we worked with recently that had us go out to a professional medical group of retina doctors, and we helped that advisor tell the cash balance story to those retina doctors at their networking group. They have a networking a group that meets once a year, and it was a great success. As a result, that advisor was able to get a number of censuses from that group and do a couple of cash balance presentations. Really seek wholesaler support, and maybe talk to your TRA salesperson who best to approach. But if you work closely with some of the 401k vendors, they're very familiar with the cash balance story. They're typically very familiar with TRA and Kravitz, and they can be great support to help you grow your business using cash balance plans. Some of them will even potentially, doing lunch and learns with you. No doubt TRA can help you with the content and help you share the cash balance story. But the 401k wholesalers that you work with on the 401k side can be great resources for you in terms of growing your business using cash balance plans. Oh, and publish and speak. Show off your expertise. If you decide that you want to learn more about cash balance plans beyond this presentation, we have a cash balance coaching program that you could have access to at cashbalancedesign.com, and we can teach you through that program how you can get articles published with your name on it. And we even help you write the article through our cash balance coach program. You can and use that to demonstrate that you're an expert in the space. I'm sorry. I said this earlier, but it doesn't hurt to reiterate. Reach out to those tax advisors, reach out to CPAs, in terms of growing your business. In terms of, definitely try to stay on message. A lot of advisors, and I make this mistake, they quickly, want to talk investments, want to talk about product. That's phase 2 of the sale. Phase 1 of the sale, and I know I said this already, but it doesn't hurt to reiterate, is we want to talk about tax savings, we want to talk about retirement accumulation, then get into the investment story. All the great benefits of cash balance plans, how much money you're going to save them in taxes, and how much money we're going to help them accumulate for retirement. Then you can talk about how you're going to help them invest the money. So think of it as a 2-step sales process. Talking about cash balance plans, particularly if someone had some experience with a defined benefit plan, that makes cash balance special and different than defined benefit plans is there's a lot of flexibility in these programs when you use cash balance. When you have partners, we have options. Partners can contribute at different amounts, so we can work with your client to make sure that if we have an older partner and a younger partner, the group is not putting in the same amount for the older partner and the younger partner. In fact, typically they can't. And if the younger partners don't want to participate, that's all possible. So a lot of flexibility in the way we design these plans. We can do what's called carve-out designs if we have a census where there's a lot of employees and it looks like it's going to be expensive to include everybody. There are ways to carve people out. It's a more sophisticated design, a little more expensive to administer, but it is possible. And then, one thing people are always worried about, what happens if their income changes in future years? We definitely have a lot of techniques, talk to your TRA salesperson about how we can minimize the cash balance contribution in future years as income drops. There's lots of things we have that we can implement to make sure that if we have a good year this year and then a bad year next year, that's always a concern. We have ways to deal with that. The message is, the savings opportunity could be limited. People do respond to deadlines. In order to get the tax deduction for 2015, we need to have the plan documents signed by the end of the year. And I know on December 1st, oftentimes, as we part with TRA, there's some additional fees that we have to assess in order to rush the legal documents out. So you might, if you're meeting with a client today, no doubt try to get them to understand that they need to make a decision before December 1st so we get the legal documents in place by the end of the year. We avoid additional fees to get those documents in place. You don't have to fund the plan in 2015 to get the deduction, but the plan document must be drafted and by the end of the year, otherwise we lose out. Because I will get these calls come February of 2016, hey Dan, is it too late to put in a cash balance plan for last year? And unfortunately the answer is yes. You cannot go back and resurrect the deduction if you don't sign these legal documents by the end of the year. Some people are concerned that, after this presidential election that we're in, that we might get tax reform one day. We've been with tax reform for many years, so who knows? But it's a great way to convince a client to get into a balance plan now while you still have the ability to reduce your taxes using a program like this. Tip 4, you definitely want to partner with experts. not all actuaries know how to work on cash balance plans. I mean, here's a good question to ask a potential partner. A lot of TPA firms say they work on cash balance plans, but ask them how many they have. Have hundreds of cash balance plans that we work on together. A lot of times a TPA might say they work on cash balance, but they only have 10 clients. And I would argue you need a lot more expertise and experience with these programs because they're very, very complicated. And we've partnered with TRA to take over some cash balance plans that were put in place by people who didn't know what they were doing, and it was very expensive to unwind those poorly put together plans and put together something that met the client's needs. Or we even saw poorly designed by other firms, and it was unfortunate, but unnecessary contributions were being made, testing was done wrong, all sorts of issues. So you definitely want to partner with experts like TRA, and definitely some of the smart tools that TRA makes example. Again, this is my favorite marketing piece. It's a glossy card that TRA has. On one side, it has a chart showing the potential contributions that can go into these cash balance plans with a 401k profit sharing plan on one side, and the other side, it reminds you who the ideal candidates are for these programs. And early, this is what we've seen in terms of the growth rate. Once a year, Kravitz publishes a national research report. You can get it on our website, cashbalancedesign.com, if you want, or I'm sure TRA can be available to you as well. We dig deep. We've done this for the last 8 years in terms of looking at what's driving cash balance growth. And no doubt, over the last couple of years, we've seen a tremendous amount of growth. From 2001, there was only about 1,300 plans. Fast forward to today, and we believe we're approaching 15,000 plans. Most of these plans were established after 2006, and that had to do with a law change that happened. The Pension Protection Act was passed that pretty much clarified the legality of these plans. Prior to 2006, there were some questions about the legality of cash balance plans that all went away as that law change. And look, almost 3/4 of all cash balance plans that are in place today were established once that law was passed. Again, this most activity that we see in the cash balance space is with small businesses. Know that there's a lot of famous Fortune 500 companies that have cash balance plans, like IBM, AT&T, Nationwide, John Hancock, Pepsi. But that represents a small piece of the marketplace. Look at this chart. Over 90% of all cash balance plans are at companies with 100 employees or less, and 55% of all cash balance plans are at companies with 10 employees or less. So again, in terms of who you want to go after, this is a market, this is a small business play. The small clients are who you're going to want to go after in terms of presenting cash balance plans to. That's where most of the growth is. This slide, this is a reminder that cash balance plans benefit everybody at your client. The average 401k plan sponsor spends about 2.8% of payroll on retirement benefits for their employees. But what a 401k plan sponsor does once they have a cash balance plan, the contributions to the rank and file employees more than doubles. It goes from 2.8% to 6.3%. The flow of contributions going into that 401k profit sharing plan from the employer more than doubles when the cash balance plan. Now, the reason why they do this is because they have to. The IRS testing that allows you to put in a cash balance plan for the business owners and allow for those large contributions, so the owners and executives require that the business owner double up on the contributions typically to their employees. But the clients don't mind doing that when we demonstrate to them how much money we're going to save them in taxes. So the story is, I'm going to save, $200,000 in taxes. They don't mind putting in $25,000 for their employees, for example. Okay. This tells the story that most of these plans are startup plans. As you can see here, most of these plans have $500,000 in it or less. And again, if you think to yourself, well, why should I bother? Startup plans, I don't want to spend all this time and energy to win a startup plan. Remember, a lot of advisors use this as a way to get access to that 401k plan where there might be $10 million. Not to mention you might have access to all the partners of that medical group or that law firm, and you can partner with them to help them with their other investments and insurance needs. this already, so I won't stay on the slide too long, but these are the different types of industries that sponsor these plans. Medical groups, again, are leading the way, representing 25% of all cash balance plans, but then it's dental groups, legal, manufacturing, construction, retail, all other encompasses all sorts of companies. Profitable professional service companies definitely lead the way, small businesses as well. After 2010, we got some regulations that give us a lot of flexibility in terms of that interest crediting rate. I won't go into too much detail here. No doubt, most plans historically use the 30-year Treasury rate as that interest crediting rate. However, we've seen let me back up. There's another option called investment-based rates, where you use a mutual fund as the interest crediting rate. I'm seeing very little interest in this option, so I won't even get into it. But businesses are using a fixed rate of up to 6%. 4% seems to be the magic number. Lots of reasons on the actuarial side for that math to work out really well and for the testing to work out really well. If you're going to use a fixed rate, oftentimes 4% as that interest crediting rate makes a lot of sense. But not least, our larger plans, participants are more have to really gravitate away from the 30-year Treasury rate, away from the fixed rate, and using something called actual rate of return. I don't have time during this presentation to explain that, but no doubt if you're interested in learning more about that, contact TRA, or again, that website, cashbalancedesign.com, has a lot of good materials on actual rate of return as the interest rate. And a good breakdown of some of the clients that we have with TRA, and it breaks down, and you can see fixed rates and 30-year Treasury rates still lead the way in terms of the optimal interest crediting rate for a lot of our clients. This slide, definitely tells the story of where we're seeing a lot of activity. California and New York have the most cash balance plans, and I would definitely attribute to the fact there's, high state taxes there. 96% of all plan sponsors that have a cash balance plan also have a profit sharing plan or a 401k profit sharing plan. Again, a quick reminder why you want to get into this marketplace. It's not just about winning a cash balance plan. It's also going to hopefully give you access to that 401k program and win that plan as the advisor. So I know we only have a few more minutes left. I'm not going to have time, unfortunately, to go through a case study, but go ahead and pass through the case study. Just share with you, there's a lot of neat innovative things that are coming into play now in the cash balance space. One thing that we offer with TRA is online record keeping, so participants have daily access to their cash balance account. There's even some interesting investment products out there. The Ping Kravitz Cash Balance Fund, something Steve Stone at Kravitz would love to talk to you about in terms of how to invest the money. And definitely, cash balance is no doubt becoming increasingly popular. It's that safe money. Cash balance plans do offer an annuity option as one of the payout options. And in the past, that was always kind of poo-pooed. Now we're finding people are interested in that option as to get their account balance. So in summary, that this presentation helped you understand how you can grow your business with cash balance plans. Definitely willing to work with experts like TRA. Hopefully we helped you figure out how to identify the right prospects. It is all about the taxes, and hopefully some tools today to help you succeed with cash balance plans. If you want to learn more, contact your sales rep at TRA. And with that, I'm going to go ahead and hand it off to Janine, who's going to see if there are any questions and field any questions.
Hear me okay?
Yeah.
All right. So I'm going to go ahead and we have line. It's available for today's presentation, yes. We are going to make that available. Bill is going to have the link available to those who participated as well as who are not able to make.
Correct.
The copy of that slide, so you will have the illustration, the sample set, skipped, but also I recognize a lot of the participants' names. Anybody who has a census with us, go ahead and send that in to TRA, and we'll quickly turn around within 3 business days a free demonstration for your prospect. So you'll be able to see a live case on the census, and the only reminder I want to give you is to make sure that you get a good census. That's probably one takeaway I want to give you, is that the census that you gather, it's going to determine how the testing works overall, including carve-out, including all the employee contributions on the combo testing. Make sure you get a really good census as much as possible, including the targeted people during 2015, all the family members who are on the census. Ask all the questions to be part of that census, not just who they want to benefit. That, I see, is the typical mistake that leads to a bad prospect or the illustration. So that was my one question. So cash balance plans typically invested conservatively. Is that a requirement? It is a defined benefit pension plan, and real quick, we need to make sure the pooled investment of the defined benefit plan matches what the pay to be for the participants. So cash balance plan will have a contribution for the participant plus that interest crediting rate that Dan talked about, typically around 4%. So when you go help them with the investments on that defined benefit plan, you want to match as much as possible to that benefit that you're accruing at that conservative rate, like 4% example. So you don't want to go crazy. The more you go aggressive on the investment, the more volatile return you're going to have on the assets, where it's going to have a hard time matching the benefits. Therefore, you will have either a higher contribution than anticipated in the years, or even in the years where you made a lot of the investment, the contribution that they were counting on the tax deduction could be lower than what they have budgeted or hoped for. So we want to hover over interest crediting rate of the contributions that's going in order to match the benefits to the plan asset. I'm seeing those are about the questions I have. Bill, see anything different or anything I missed?
Yes. We addressed this. How do you guarantee the 5% return?
Guaranteed 5% return. What that means is the interest crediting rate. Therefore, benefit as a participant on cash balance plan is contribution plus the actuarial interest rate that we calculate. So you have to give that to the participant no matter how the investment have performed in the plan assets. Therefore, if the money is short in the assets, additional contribution will have to come in from the employer. If there are over access in the assets more than the benefits, then it may have to be returned to the employer for excise tax. That's why you want to hover over that interest crediting rate for doing the assets, but the benefit to the participants are always contribution plus the ICR interest crediting rate. That's how we guarantee benefit, and it's up to you to help them with the investments to match as much as possible. I see another question. What is the calculation for the 5 to 7% profit sharing, and does non-elective contribution count towards those calculations? Yes. So we could do a combo testing, combining what you give to the employees under the profit sharing along with what you get from the cash balance. So overall, non-discrimination testing, if you're familiar with the cross-test or new comparability, it's the same concept. So the money that's going into the employees under the profit sharing will count towards that new comparability testing, counting towards the cash balance that the owners or other participants may be getting. And yes, if you have a safe harbor that is non-elective, that will count towards those profit sharing contributions as well as any other regular non-elective contributions. What does count towards those 5 to 7% that Dan talked about would be the matching contributions. The deferrals and the match under the DC plans are part of the overall average benefits percentage test, as some of you may know, but towards the what we call gateway 5 to 7.5% requirement, only the non-elective contributions, either safe harbor or profit sharing, will count towards.
Thanks, Janine. Another question for you. Search for companies that may already be doing this, like a 5500 search.
So there is a pension code under the 5500 form 5500. There's a pension code called 2A, which stands for either age-rated, if anybody ever still uses it, or new comparability. So if you ever pull those 5500 listing or look at your client's DC 5500, code 2A stands for at least the feature in the plan that's new comparability. Another question is, do you have a census worksheet to use and that available? Reach out to any of your TRA salesperson. We have a template you can use on census work, but we pretty much take any other census form in order to do the prospect and or the illustration.
Okay. Employed, can a bigger percentage of total income go into the plan? 20% of net, et cetera?
Or can a bigger percent of total income into the plan? If I'm understanding the question fully, but if the question is, can they put in more money than what their component is, the answer is yes, possibly based on average compensation. We can use historical compensation based on their age. If they have been in the business for a long time but haven't had a pension before, we can do that. But on a brand new startup company, we may not be able to do that. So it's a case by case. But typically, we do need compensation after the deduction in order to have a percent of the income go in. So self-employment income, we need self-employment earnings, and some compensation in general.
Another, how much does it cost the company to set up a cash balance plan, and how much is the annual cost?
Right. So the rate we have 3 products. We have a solo cash balance plan starting at $1,800 set up, $1,800 a year. A standard cash balance plan, 3 set up a year, plus some plan where we get into carve out and more common plan, $4,200 set up, plus $42 and $50 per participant. But you can get all that fee instruction and information, or even a service agreement, through TRA salespeople.
Okay. Another question. The employer does not have to contribute for the employees in the balance. Does that mean his contribution to the safe harbor?
See that question now, Bill. So you don't have to cover everybody, Dan said, in the cash balance plan. Does that increase the employer's contribution to staff in the DC plan? Maybe. Again, if already doing new comparability, like 5% to staff or more, that may be good enough, depending on the graphics and who we include in the cash balance and whom we may exclude in the cash balance. As long as there are some employees getting 5 to 7.5%, depending on how big the cash balance benefits are to the owners, that may be good enough. So if they're just doing safe harbor today of 3% or 4% match safe harbor, yes, the contribution for certain staff will increase to at least 5% total or to 7.5% total. But it all depends on overall budget. We like to show the percentage of the overall contribution going to the owner, and that will increase dramatically proportional to what you may have to increase to your staff on a selective basis. see anything else I might have missed or any questions you may have?
Can you hear me?
Hi, Craig.
I think one of the important things is to talk about what type of income can be used.
Sure. Great question. What types of income can be used to count towards these contributions? So definitely for corporations, you have to have a W-2 income. A lot of times you may run into S-Corp owners where they don't take W-2 income, but they may have all pass-through income. We want to make sure their compensation is through W-2 under the corporation. So that will increase their otherwise the payroll taxes that they were not paying. But again, as Dan illustrated earlier, the big savings come in on the contribution that you put in. Therefore, we will need the W-2 income under corporation. Partnerships, they get a schedule called K-1 you may be familiar with. Under K-1, they have to have employment earnings. I believe it's line 14. So again, something under the K-1 partnership income that they pay payroll taxes like the Social Security and medical and FICA. So we add for the partnership and it will reduce based on contribution calculation that we do. And finally, for self-employment individuals where they file 1040 and they just have what they call Social C, we also need the income at the end, before we need to have self-employed income, so they can't quite zero out the income before the pension deductions because we will need base of that self-employment income in order to calculate meaningful cash balance contributions. Does that question, Craig?
Yes. Someone asked a question earlier about a 401k for a solo K with a cash balance plan on top of it. It obviously allows them to contribute a bigger percentage than 20% that they're capped at with SEPs. So we absolutely can explode past the 20%. Okay, with the cash balance.
Yeah, the percentage will be a lot bigger at some, sometimes bigger than 100% of the compensation. You're right.
And the importance of getting with the CPA if you can, because a lot of times the above and below the line that's there, and they're the CPA, their goal is to obviously lower the tax burden on the person in client, and a lot of these folks still don't know about cash balance plans. So educating them in a polite way and working with us to help you show that and make it very clear of why increasing the take-home pay for certain people, especially where there's husband and wives involved, where they've been showing a $70,000 W income for the owner, and then a $25,000, $30,000 paycheck for the wife, or first if the wife owns the company. That's they're missing on huge opportunities, advantages, tax savings, actually showing a little bit more income, the potential for both the husband and wife, if there is opportunity, there's disposable income to do so.
Thanks. Dan, Janine, thank you much for your time. Great presentation. If there is no questions, we're going to wrap up this webinar session. If you like to continue the conversation, contact your TRA regional sales consultant at 401k.com/sales. You'll be able to talk based on region. Like Janine had said earlier, we will be forwarding a link of this recorded webinar as well as attachments that consists of the presentation itself, the deck, to everybody that attended and the people that didn't. And any additional information regarding cash balance, please feel free to reach out to your TRA regional sales consultant or myself. I can be reached at Bill Thunigal at TRA401k.com. Again, time and participation, and have a great day. Thank you.